Welcome to PutPath 101. We're going to go over the not so fun stuff in this lesson. So this is lesson 1.2, the risks of options trading. All right, so you may think it's kind of strange that we have the introduction to the course and then the very first lesson after that we get into why not to do this. So I got the stop sign up here. I'm saying, look, there's a lot of reasons for you not to do options trading, especially for beginners. So I just want to have a word of caution. I want to let you know a lot of the risks that are involved. There's several different types of risks that we're going to go over. I want to give you some sobering statistics. Is basically, 80 to 90% of retail options traders lose money. So I want to make that very clear from the beginning. These are leveraged financial instruments. And if you don't have a basic foundational knowledge of how markets work and how stocks and ETFs work and how risk works and how your own psychology is, you may just want to leave right now. But if you feel like you've got the maturity and the basics to start the course, then continue to the next slide. You need to think about, is options trading right for you? Options trading requires a certain level of financial knowledge before you can get into it. If you've been trading in the markets for many years and you understand the basics of how to buy and sell stocks, that's great. That's a good introduction. But it does require an additional level of financial sophistication so that you understand a little bit about risk, about statistics, about the normal curve, and how to enter and exit into contracts. So some of these strategies and market mechanisms take an advanced level of sophistication so that you can manage your risk and so that you don't get yourself into trouble with your positions. Options are not suitable for everyone, particularly people with gambling addictions, people who get high off of big wins. If you're trying to 10x your account, if you're trying to get 100% returns every day, options trading is not for you. You should just walk away, because I've seen it with traders. You see people online, you see people in Reddit forums where they've lost hundreds and thousands, some of them over $1 million in options trading. 80 to 90% of options traders lose money. 16% of all options traders take their account to zero. So you need to be serious. You need to have a clear mindset. You need to be clear on what your objectives are, and definitely don't risk more than you're willing to lose. So why do we want to learn about the risk? And what are the primary risks? Risk management, risk mitigation is one of your primary objectives in options trading. So you can see the picture here of the guys just sitting around rolling the dice. You don't want to be like these guys. You got to understand your risk, and you don't want to be a gambler. You want to put the odds in your own favor. So understanding risk is key. And again, never risk more than you're willing to lose. So in this lesson, we're going to go over the primary risks, which are market risk, volatility risk, timing and expiration risk, liquidity and execution risk, psychological and behavioral risk, and then capital and position sizing risk. Okay, so now we're going to explore market risk. So what risks are associated with the markets themselves? So you have to understand we're in a global market. We have the biggest stock market in the world. We're intertwined with other countries with globalization. We have thousands upon thousands of people trading stocks at the same time. You've got stockbrokers that are the insiders that really know the business. And you've got Wall Street hedge funds. You've got analysis firms. You've got professional traders that are doing this all day, every day. So these are the people that move the markets. So adverse price movements can come from a significant world event, could come from a war, it could come from a decline in GDP, any kind of macroeconomic data that's unfavorable. These types of things will move markets. So these things can lead to unexpected losses. So significant economic events like earnings reports, policy changes, new presidents, new administrations, new House of Representatives, or new bills that are passed, like Obamacare or something like that, these things can move markets specifically to the events that they are affecting. So they can have a quick effect. You can have, for example, USO can be affected dramatically, which is our oil ETF that we track. That can be affected by wars and things of that nature. So, risk awareness in the market. How is this going to affect how you perform? You need to be aware that some things are completely out of your control, whether you had picked the right stock or the wrong stock, whether you timed it perfectly or didn't time it perfectly on the entry point or the exit point. Sometimes the market has its own overriding, overwhelming vote in how well your trade does. So let's remember to respect the market. Let's remember to try not to time the market. Let's remember not to fight the market. The way I look at it, there's a lot of people who are dedicated to this full time with a lot more resources and power, and you can't beat them. So don't try to. And most of all, don't think that you know anything. Nobody knows anything. That should be the catchphrase for options. So one of the main things we need to understand is volatility. Volatility is highly linked to pricing in options trading. It's the one variable of the Black-Scholes model that you can't solve for. So it really determines the price of your options. So what we look for is try to take advantage of those volatility effects. Implied volatility is going to increase as your pricing of your options increases. It causes the pricing of the options to increase. So what we want to do is, in terms of selling, we want to sell in times of high volatility. So when the VIX is high, the SPX, the SPY is typically going to run lower. And in these times of lower, when the underlying is going down, that's actually the best time to sell options, because as the fear is up, the price goes up. So obviously the best time to sell something is when the price is high. So you have volatility spikes in the market. These can be market-wide, or they could be related to a specific commodity or underlying. It can lead to rapid change in the option price. It can lead to rapid change in the underlying price. Typically, as the underlying price starts to drop, if it starts to accelerate, if it is going down quickly, you know that volatility will be rising. So what we want to do when our positions start to lose and go beyond that 200% max loss that we've set, we want to cut those positions. We want to close them out so that we can mitigate extreme losses. In managing volatility, understand when to get into a trade, when to get out of a trade. Obviously, we can't control volatility. We can't control markets. But what we can do is think about when we enter the trade, when we exit. So obviously, when we exit, we're going to exit for a 2-cent debit as a full winner nearly, or we're going to exit at our 200% max loss that we've set on ourselves. That's the key to the system. That's the key to managing your risk and managing volatility. Next major risk we want to talk about is timing and expiration risks. So when we talk about timing, that's obviously crucial to options trading. Entering in too early or too late can mean that you lost. So we need to learn how to try to time at the appropriate point to get into the trade and how to close it out at the appropriate point to get out. expiration pressure is another big one. So as the market approaches the expiration date, the gamma risk starts to increase. And that can impact you if you're on the verge of an at the money position. So the position will become extremely sensitive to price changes. We want to avoid that if we can by closing earlier in the cycle. And then capital allocation. So proper allocation is vital. What we're saying here is if you close out your trades earlier, you're going to get that capital back and you're going to be able to remove any risk that the trade will become a loser. So the earlier you can trade, close out your trade, the better. You free up your capital and you determine that you definitively have a winner. All right, let's get into liquidity risks. So these are very specialized and determined by the underlying that you're getting into. So we have selected these 12 underlyings specifically for that reason. We want high liquidity. We want a lot of traders. We want a lot of volume in the trade. What that does is it narrows the bid-ask spreads. It provides us with a easy target for our mid price. A really wide spread can lead to poor fills, can lead to bad pricing when you get into the trade. Also, closing positions. This is huge when you try to close. You don't want to get into a roach motel where you can get into the position, but you can't get back out, especially during times of high volatility. When you're trying to get out of a position, you need to have a counterparty that's ready. So that's crucial. When closing positions, we want to make sure that we have a liquid underlying. And then third, market slippage. So in order to get the best pricing, you really need big markets, lots of buyers and sellers that provides that definitive price and allows you to close it near mid price, near the bid ask middle, so that you can get the best pricing when you open your trades and when you close your trades. Additionally, you need to understand your own state of mind. You need to understand that the person that you're really trading against is yourself. And what I mean by that is you're always trying to get better. You're always trying to reflect. You're always trying to understand your emotional state when you're opening trades, when you're managing trades, when you're closing these trades. So what are some emotions that I'm talking about? Fear. Fear can cloud your judgment, particularly if you are on the buying side of these trades where you bought a long call. You're trying to see how far a particular underlying is going to run up. Fear also can make you close the trade that you sold too early because you're too worried about a position that looks like it's in trouble. But that's why we have the 200% rule to take that away from you as a decision point. So try not to make hasty decisions. Have your rules, have your system set up, and then you go and you execute mechanically and solidly. Greed is another one that drives traders to make bad decisions. Again, greed is more on the side of your long call where you're hoping that you're going to hit that 10x and you're hoping that the option that you bought for $1, you're going to be able to sell it for $10. So the greed is really a double-edged sword because you obviously want the highest profits possible, but we actually approach trading differently where we're trying to get small wins over time to add up to the bigger rate of return. And lastly, overconfidence. So a lot of times, particularly with traders who are selling naked positions, naked puts, naked calls, you can get overconfident. You can say, okay, this position or this underlying hasn't moved in 3 months, hasn't moved in 6 months. So I'm going to keep hammering that naked put that you sold, not realizing that, hey, there's a market shock, there's a buyout, there's a earnings event, there's some kind of drop in the market that can cause you to lose significant money. All of these things we try to take out of the equation by giving you a system and giving you a playbook on what is successful. Another big risk is your capital and your position sizing. So what we want to get across here is the dangers of over leverage. Now, obviously, options are leveraged financial instruments because you're getting 100 shares of the underlying and you're controlling that potentially. However, this leverage amplifies gains and also amplifies losses. So what we need to understand is that risk management is one of the most important things you can think through in options trading. What's my max loss? What's that normal curve? Where are we in the normal curve as far as expected outcomes? And how are you going to mitigate against worst case scenario? Get out of the trade quickly if you need to. Those sorts of things. In terms of capital, what we're talking about here is managing the overall amount of capital that you have dedicated to options trading. I recommend that you have your normal investment account, and then you have a small piece of that you use for options trading. That's these highly leveraged, potentially highly profitable instruments. Never risk more than you're willing to lose. And lastly, the importance of position sizing and diversification. So you don't want to have a 12x position in one underlying. It's much better to have 12 underlyings with a one lot. That way you're diversifying. It's the old phrase, don't put all your eggs into one basket. You want to make sure you're spreading that across multiple underlyings to get that uncorrelation potentially, and to have multiple underlyings that you're trading at one time. Just a word of advice here. Discipline beats emotion every time. That's from Bruce Lee. So what that means is we're emphasizing consistency. We're emphasizing doing the right things over and over. We're emphasizing winning a lot, small, and then losing a little bit small. And then you just repeat that over and over and over. Rely on your mentality, rely on your system, rely on disciplined trading, and in the long run, you'll be successful. So that's the crux of it. We've walked you through the 6 major risks. Want to just reiterate to you that the put path strategy is built on discipline. It's built on mindset. It's built on systems, clear rules, clear entry and exit points that should add confidence to your trading, and that if you stick to it over time, it's going to provide excellent results. We've seen 50% or more annual rate of return since 2023 documented. You have to use the 200% stop loss rule though. In Tasty Trade, you can set it up to automatically trigger, but you have to monitor your other accounts to make sure that you manually enter in those orders at the 200% stop loss. It hurts to lose, but it's critical. So key takeaways. Again, let's just reiterate, you got to be prepared for surprises. Nothing turns out the way you expect it to exactly, and no strategy is risk-free. What we try to do is mitigate these 6 risks, make sure that we are doing everything that we can to control outcomes, but ultimately you're going to have about 15% losers, and you need to be ready for that. You need to be ready for market changes. You need to be vigilant. You need to be prepared to close out trades if you need to. And you need to be able to tweak your strategy so that you are nimble and so you're paying attention and you can minimize losses when they occur. Stick to your trading rules. Developing a system and adhering to it is key. It helps your emotional responses. It helps you to reduce stress in times of turbulent markets. And lastly, let's remember what we're doing to mitigate these risks. So the reason that we have the put path is to be able to take these risks, stare them straight in the eye, and understand that we're mitigating against them by doing these things. We recognize the risk, we respect the risk, we acknowledge the risk, and we're making informed trading decisions based on risk management. So what are we doing? We're using defined risk strategies where we know our max loss, we know what the expected range of the trade is, and then if we go outside of the limits of what our expected value is, we close the trade early. We maintain discipline and control. We monitor our positions. We make sure that we have our emotions in check and that we're following the system so that we're minimizing losses and we're closing winners as quick as we can. And we avoid impulsive decisions, which can lead us to losses, which can lead us to revenge trading and all kinds of other negative emotions.